Hello, everyone, and welcome to day 2 of the 2025 US Expats Financial Conference, sponsored by Expat Focus, the web's favorite destination for anyone moving or living abroad, and Wise, a leading provider of fast, low-cost international money transfer services and multi-currency accounts for individuals and businesses. We have a fantastic schedule for you consisting of 9 sessions over 3 days, covering multiple aspects of financial information for Americans living abroad, with perspectives from some of the world's leading experts in their fields. Today is the second day of the conference, and for this, our first session of the day, I'm delighted to be joined by Nathalie Goldstein from Expat Taxes, who will be discussing US tax filing requirements for expats in 2025. Before we start, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own financial advice. Note also that while the conference is free to attend, if you'd like to leave a tip for the organisers, you can do so using the PayPal link that I'll drop into the chat window at the foot of the screen. Nathalie will be answering your questions after her presentation, so please add them in the Q&A pop-up at the foot of your screen throughout, and we'll try and answer them all at the end, time permitting. So without further ado, over to you, Nathalie.
Perfect. Thank you so much. So let me go ahead and share my slides, and then we can jump into it. So yeah, welcome to the first session of today. I hope it is interesting and gets you excited about taxes. I know I'm a little overenthusiastic. It's probably the sun showing up today. Anyways, what do you have to know about filing US taxes from abroad this tax year? So what we'll talk about is, as Hugo alluded to, what tax savings there are, what increases in refunds are potentially there for you as a US taxpayer abroad, and of course the basics of US Tax 101, catching up through the streamlined procedure, and FBAR, FATCA, all that information that you have to also know alongside your US tax return. So before we get started, let's just talk about the general deadlines, right? As we are recording this, and I know it's so much in the news, but we are still in a citizen-based taxation regime. So we still need to generally file our US taxes as Americans living abroad. And as we have to file our taxes, what are some key deadlines that you should be aware of this year? Because the deadlines can change a little bit depending on if the deadlines fall on a Sunday or a holiday, etc. So of course, April 15th, we all know this deadline. That is the first deadline there is. That is still an important deadline for expats if you owe taxes. So if you do owe taxes, we always recommend to try to file by April 15th. If you don't think you owe taxes, then you can definitely wait until the automatic 2-month extension till June 16th. It is June 16th this year just because the 15th is falling on a Sunday. So that is a little bit of an interesting situation in itself, because how do you know if you have to file? And wow, look at all the fireworks. How do you need to know if you need to file? But essentially is, if you think you might owe taxes, maybe you owe taxes on previous years, maybe you moved abroad in the middle of the year, maybe you still have a lot of US sourced income. There are a couple of different reasons why you may owe taxes. And so if this is generally your situation, please look to file earlier. But if you know you're not going to owe taxes, you only have foreign salary, you're always using the foreign earned income exclusion, foreign tax credit, etc., then you definitely can wait. If you're unsure, you can always try through, of course, Expat Taxes. And I realize I just jumped through the intro because I'm so excited to talk to you all about taxes. But, a little bit about me from California is I'm just like you. I moved abroad and I had to file taxes. And in that process was, again, this confusion of, okay, but I have to file by April 15th to pay, but I don't really have to file until June 16th. And then what expat tax benefits do we use? So with all of that, we decided to create Expat Taxes, which is the leading tax software for US expats. More on that later. But what's important for you to know based on the tax deadlines is, if you're not sure if you owe taxes, you can always try to model your tax return first on Expat Taxes. You can do that completely for free without paying, and just see before you ever hit a payment screen if you might owe taxes or not. And this can be a guiding light to know what deadline do you have to follow. So those are the general deadlines. Of course, you can always extend to October 15th, which is the filing extension with Form 8968. And then if you want to extend further, you can always extend to December 15th. And that is a little bit of a more difficult extension because you have to actually submit the signed letter to the IRS. So you have to write them a request to say, hey, I have, a foreign financial company. I have, I'm waiting for local documents. So I need even more time past October 15th. But just so you know, those are the 4 general filing deadlines. There's April 15th, June 15th. You can go to October 15th, or if you really need, then December 15th. And of course, if you need to file back taxes, please do that as soon as possible, because in the event that you owe taxes, there are penalties and interest that accrue on the tax that is owed. And so as we look at who actually needs to adhere to these deadlines, the general threshold is what you see on the screen. If you are a US citizen or a US green card holder, and this is kind of the tricky part, is there are a lot of folks that have a US green card and they leave the US or they let their green card lapse. And they think, okay, well, that's it. I don't live in the US anymore. I don't work in the US. I don't have to file US taxes. The rule is if you're a US citizen or if you have a US green card and you haven't formally revoked your US green card with the form I-407, you are still considered a US tax resident, even if you are not physically a resident in the US. So with that being said, depending on your filing status, you will have to file if you meet these filing thresholds. And again, when we think about a filing threshold, it's your worldwide income. So it's all of your salary, it's all of your interest income, investment income, rental income, all of that before expenses, before deductions, before taxes paid, is your gross worldwide income. It can also include, Social Security benefits, pension income, etc. So all income from all sources. And if you are over these filing thresholds, then you have to file a US tax return. And I want to call out, obviously, you see on the screen, the married filing separately amount is very low. It is $5. And it's been that way since tax year 2018, and it hasn't changed. And that's because the IRS tends to see if you're married filing separately, then it's the least beneficial filing status. And so if you even have interest income from, I don't know, maybe a US bank you don't use anymore that's over $5, or from any foreign bank, you would technically have to file a US tax return. And married filing separately is a very common filing status for expats, especially if you're married. So if you're married to a non-US citizen and, they decide that they don't really want to be on your US tax return, I don't blame them. You might be under married filing separately because you can't file a single if you're married. I do want to call out that in the event that you're married to a non-US citizen and you have a US child or you have a US dependent and you qualify as keeping up for, more than half of the home, so paying for more than half of the cost of keeping up the home, you might be able to file as head of household, and then you have a higher filing threshold. Another thing to call out is obviously you see at the bottom this self-employed. So self-employed is not really a filing status, but if you are self-employed in any sense, so even if it's not your main, income source, if you're just freelancing and maybe you're writing content on the side, I don't know, maybe you're an influencer or anything, if you have some type of freelancing income you would normally report on Schedule C of your US tax return, if that is $400 or more, the net profit of it, then you will have to file a US tax return because you may be subject to self-employment tax. So it is rather tricky sometimes to know if you have to file a tax return or not, because as you probably just realized, there's these if, ands, or buts about, filing US tax returns. My general advice is if you are earning enough money to live, you might have to file a US tax return. Definitely look into it. And even if you're not earning a lot or you're not working at the time, if you are getting income from investment income, and it can be, like I said, $5 of bank interest, right? You might still have to file a US tax return. So unfortunately, it is something that continues to follow the majority of us living abroad. There are some benefits though. It's not all bad news. So a couple things that I want to say is there are increases every year that do tend to help us. So the first one is, of course, the standard deduction will always increase. The standard deduction is in line with the filing threshold. So what I just showed on the last screen, that is normally your standard deduction for your filing threshold, with the exemption of married filing separately. So if you're married filing separately, you'll have the same standard deduction as single. It's just the filing threshold for married filing separately is a lot lower. As usual, with inflation, tax brackets will continue to increase even though the rates stay the same. So that just means that you can earn more money and it's taxed still at a lower rate, or it's at least not taxed at a higher rate. And of course, if you are someone that is using the foreign earned income exclusion, because of inflation, that tends to increase every single year. So now it's jumped up by another $6,500 to $126,500 US. So this is really great for those that are higher earners in low income tax countries. So for example, if you're in Switzerland or you're in Hong Kong or you're in Singapore and you are a salaried worker, this is a great benefit for you to know that it keeps increasing, because that just means that you can exclude more of your foreign earned income and potentially not be subject to US taxation. Of course, this is also important for those that are potentially digital nomads. So if if you're, I guess we don't really call them digital nomads anymore, but if you're a remote worker is also another term. Is, say you're working for a US company, but you're working abroad. You don't have to work in the US, you're jumping around, and you are abroad for long enough, so 334 days in a tax year, you could potentially also use this benefit, and then that making your foreign earned income potentially tax-free. And my favorite increase is the actual refundable part of the child tax credit. So the additional child tax credit, that has continued to increase. So for a long time, it was only $1,400 that you could get as a potential refund for every child that's a US citizen, has a US Social Security number under the age of 17 on your tax return, assuming that you're not using the foreign earned income exclusion. And now it just keeps jumping. So it's jumped from 1,400 now to 1,700. And I hope it continues to jump next year, right? But I think that that is something that is at least nice about filing a US tax return, is there are cases where you can get a refund. Most people have to file tax returns. Most people will not owe taxes. And a good handful of people will continue to get refunds and actually get money from the US government, even if they're not paying taxes to the US government. And one way is through the refundable child tax credit. Couple other things to note, right? Because there's always so many changes every single tax year. And I'm sure next tax year will be no exception, because obviously we now have a change in, top leadership. But for this tax year, as we talk about, is know that for IRA contributions, you do have an increased limit on how much you can contribute. So if you are still contributing to your individual retirement account in the US, you can contribute more. And remember, you can still contribute to that account up to April 15th. We do have more information on that towards the end of this webinar. If, again, you're in this bucket, if you do still have a US IRA, on the other side of it, if you are older, just keep in mind that you may be subject to required minimum distributions, meaning that you need to pull out a certain amount of money from your US IRA accounts every single year after a certain age. And then if you don't do that, you could be hit with a tax. This tax has lowered. So it's, it used to be 50%. So it's lowered quite a bit. However, just something to also keep in mind that you might still be subject to doing these things. So if you are an expat that still has US assets, there are things that you obviously need to still think about if you're contributing or, distributing from these US assets. Another part, and like I talked about, is the refunds. I know it's been so long, right? It's been, COVID was like another world. It was another age, but there are still stimulus payments on the table. So for those that are in this call and you still haven't filed your 2021 tax return, if you haven't filed it, get on it, because this is the last chance for you to get the final stimulus payment. And that is $1,400 per taxpayer, plus an additional $1,400 for all the dependents that you can claim on your tax return, or if you're married filing jointly, right, another $1,400. So it's still quite a lot of money. And if you haven't filed a 2021 tax return, please do so as soon as possible. Technically, you can still claim this up to June 15, 2025. We really recommend you do this before April 15, just to make sure that the IRS cannot argue with you, because generally you only have 3 years till the deadline, 3 years past the deadline of that original return. And of course, expats have an additional 2 months extension. However, with our experience on the 2020 stimulus payments, it's just easier. The sooner you submit this, the easier it is that you will get the refund and you do not have to fight with the IRS about it, because fighting with the IRS is not fun. Another thing I just want to call out is, of course, there's so much in the media about direct free file. And I really hope, with all the money they put in it, that they make a great program for people to make the tax filing process easier. Of course, us expats are always kind of the last to get looked at. And again, that's one of the reasons we created My Expat Taxes, is we're just not really in the supported cases. So you still see the alert right now if you get on the direct free file that you cannot use this if you don't live in the US. So if you're international taxpayer, check again next year, I guess is what they try to say. Hopefully it gets better, right? But as we sit in this kind of weird pool of having to file taxes in the US, but we don't live in the US, we are unfortunately not really supported yet by most US-based tax softwares. And again, because this webinar is about filing taxes in this new year, just a couple of other things that are not directly related to your tax return, but stuff you should have in the back of your mind is, if you are selling anything online, right? If you're, it really could be anything. If you're making stuff on Etsy, if you're selling stuff on Amazon, if you are really doing anything with these credit card payments, so it could even be, Airbnb transactions or anything like that. The IRS is really trying to increase their compliance here. And that means that there's a new tax form that they start issuing out. So I think if you have US investments, you're very familiar with, a 1099 INT, a 1099B, a 1099 DIV, so 1099 div form. They also have another form, a 1099K, and it's not new to this year. It's already been out for 1 or 2 years. However, it's now going to be issued to a lot more people. So there used to be quite a high filing threshold that before anyone would issue this form. And now the IRS is starting to say, no, anyone that makes, some, how do you say, what they would call as reportable income, they need to basically have a paper trail. So what they're doing now is, if you made over $5,000 in calendar year 2024, somewhere online, right? So through credit card transactions, Amazon, Airbnb, whatever, you should expect to get this form, 1099K. Next year, they're going to lower it even more. It's going to go to $2,500. And then for calendar year 2026, it's going to be $600. So again, the IRS is really upping their compliance on, if you're selling anything online and they know that you're a US citizen, they will expect that there's a paper trail. And this is important because we've seen it a lot already in this past tax year, where people will file their US tax return, but they won't realize that, inside of their Airbnb portal, inside of, the Patron portal, anything, that there is a 1099K form waiting for them. And then they don't realize that and they don't report it on their tax return. And then what happens? A few months later, you get a letter from the IRS saying, hey, you didn't report all your income because we have record of a 1099K form. So I say it there so you have that in the back of your mind. If this is you, if you are selling anything online, it may be possible that the platforms you use have issued you a 1099K form. And this is very important that you look for it, because the IRS has a record of this. And so they expect you to report this on your US tax return. That was not so great news. So just increasing compliance. Better news, right? And I realize I'm doing like a reverse sandwich method, because it's bad news, good news, bad news, but sorry, this is tax. The better news is we did see that the windfall elimination provision is eliminated. So as our last president left the office, they went ahead and eliminated this elimination provision. And while we're not Social Security benefit experts, what we can tell you here is basically there was this provision that if you had income that was not subject to Social Security tax in the US, so basically people that had foreign employers, it could be that later on your US Social Security benefits would then be reduced, because it says like, okay, well, you're getting income from other places. This has now been taken back. So this is great for expats. So, if you have eligibility to get Social Security benefits, technically you should be able to get as much as you're entitled to without any further reduction for being an expat. Of course, it all depends on how much money is in the pot as we get there. But that is something that I think is very cool. And while it's not in scope for this webinar, also something to keep in the back of your mind that if you are an expat, if you are living abroad, there are still chances to contribute to US Social Security benefits. So if you know anything about Social Security benefits, you do have to have 40 credits to be eligible to get US Social Security benefits when you retire. A lot of us expats that we move, maybe a little bit earlier on in life. So for example, I moved in my 20s, right, is I don't have the full 40 credits, but I have almost a good chunk of credits because I was a W-2 worker, while I was in the US. And so what you can do is you can actually be reporting self-employment income. Obviously you have to earn it, but you could be reporting your self-employment income from abroad and subjecting that to US self-employment tax on purpose, if there is a totalization treaty. If there's not, then you have to pay self-employment tax anyways. But you could basically still pay self-employment tax from abroad, and that will still get you credits. So if you're very close to the 40 credits and you want to be able to get the 40 credits so that you do get US Social Security benefits later on, it's still possible. It's not in scope for this webinar. We'll talk a little bit about how, if you want more information on that, you can get it. But I think it's important that as you file your US tax return, you understand, what you can and can't do. And there's actually a lot of things that you might be possible that you can do. Okay, that was the good news. Back to the bad news. The other bad news is net investment income tax. You've probably seen this in the news. I feel like there's so many things about expats in the news. We are really creating the conversation there. However, there is another court decision saying that, yes, per the tax treaties, you should allow foreign tax credits against net investment income tax because otherwise it is double taxation. And yes, I do believe it is double taxation. However, the IRS is continuing to just appeal and block these court decisions. So as of now, even though you'll see in the media that, hey, another court has says, yes, you do allow foreign tax credits, the IRS has not approved this. So until they say, yes, we agree and we approve this, there's actually no way to do that on your US tax return. So for your 2024 taxes, if you have been paying net investment income tax, if you are a high earner with a lot of investment income, expect that you will still be subject to net investment income tax, which is 3.8% of, either, I won't get into the calculation, but approximately 3.8% of your investment income. That's a lot of information. Let's get to streamlining. So in the event that I have potentially made you a little bit anxious because you haven't been filing your taxes, I just want to tell you there's no need to be. There's no need to be anxious. If you have been filing your taxes regularly, if you haven't been filing your taxes, the IRS is actually very understanding. So like if I say that, I know you don't believe me, but they generally are quite understanding, right? Depends on the agent, of course. If you haven't been filing your taxes, what you can do is you can still complete your 3 back years of taxes. So even if you haven't been filing for 10, 20 years, you can just go through the streamlining procedure as an American abroad, and you can file 3 back years of taxes only. So it's capped, right? So only back to 2021. And then you file 6 back years of your foreign bank account reports, which we'll talk about, but you only have to file 6 back years. This means that you'll be going through streamlining. And then once you pass it, you're seen as compliant. So your slate is wiped clean. So even if you haven't filed those past 30 years, the IRS will just say, slate is clean, just be compliant up to now. And then this is also important because if maybe you have been filing, but you realize you haven't filed the right forms. So for example, we have a lot of people that come in that will file with a US-based tax software or a US-based tax firm. And then there will be things that are missed. So maybe they have a foreign corporation that is, has limited liability where they live. And they think, well, this has nothing to do with the US, so we don't report this. But actually you needed form 5471, which is a very high penalty form, $10,000 if you don't file the form. They need to include this. Or maybe you have some type of more complex foreign pension or a private pension that you needed form 3554, which is also a high penalty form. Or maybe you forgot, to report all of your bank accounts and you had over a certain amount, so over 200K, and you have to report it on this FATCA form, which is also a high penalty form. It's not that all is lost, right? So if you have been filing, but maybe you forgot some very high penalty forms or you made some mistakes, you can also go through the streamlining procedure and amend those returns to include those forms to get ahead of the game so that you can remove those penalties before they ever come. So again, I do think that the IRS is generally understanding. Um, as we said, most expats do not actually end up owing taxes because of the expat benefits that I will talk to you on the next screen. But a lot will get refunds, and especially if you haven't filed your 2021 tax return. And I'm going to say this like, at least one more time in this presentation because it's so important. If you haven't filed your 2021 tax return, make sure to do it ASAP because this is the last chance for you to get that $1,400 refund, which literally will pay for your tax return and more, right? If you go through streamlining. So I think it's worth it, right? Um, okay, expat tax benefits. So why do you end up not owing taxes, right? Why should this US tax filing procedure not be as scary as it might seem? Well, that's because there are two main expat tax benefits. So the foreign earned income exclusion and the foreign tax credit. Foreign earned income exclusion is as it sounds. It is a chance to exclude your earned income that is foreign sourced from US taxation and a very high amount of it. So as you see, 126,500 US dollars. On top of that, you also have the chance to exclude housing deductions, housing exclusion. So it is a very great expat tax benefit. Just a couple things you need to understand about it is for foreign earned income. You can only use this for earned income being salary, self-employment income, active partnership income. Earned income is not pension income. It is not social security income. It is not investment income. It is not rental income. Earned income is income you earn for your services rendered, and it must be foreign sourced, which when you look at earned income, the way the sourcing works is that you physically were abroad when you worked and earned that income. So something else that can cause some confusion is if you are a US taxpayer and you're working for a foreign company, you live abroad, you live in Germany, you work for a German company, and because you don't need a visa to go to the US, maybe your boss says, hey, we need you to do a business trip in the US for a month because you can just stay there for a month and work from there, right? It's so easy. You have US citizenship. Not necessarily, because now that daily income you earn while working in the US for that 1 month is now US sourced because you physically worked out of the US. It's no longer foreign sourced. So you cannot exclude it on the foreign earned income exclusion. You can still claim tax credits, and we'll get into that. But just remember, it is for foreign earned income only. So very straightforward form, I think, to use. It's Form 2555. You put it in your tax return. Pretty easy to use, especially for those that are living abroad for more than a year. However, if you do use it, you will disqualify yourself immediately for the additional child tax credit. So it might not be the best approach to use. And if you are still contributing to, your US IRA, it can make it a lot more difficult to contribute because it can basically wipe out your taxable compensation. Foreign tax credit is another approach, and it's a little bit more flexible. It's actually a lot more flexible. And what it does is it uses the income taxes you pay abroad as a direct credit against your US tax liability. So if you're paying, 30,000 euros of income taxes in Germany, you can use the US equivalent on your US taxes on your US tax return. So if you owe 25,000 on your US tax return, consider that you owe nothing afterwards. I think it's really flexible in general because one, you can still claim the additional child tax credit. It gives you enough taxable compensation for your IRA contributions. This is not on the screen, but what is also great about it is that you have the chance to carry over credits. So what I mean about that is imagine you're a salaried worker in Germany and you're paying really high income tax. And I just picked Germany. I don't know, it could be any country, right? France, whatever. But you pay a lot of income tax on your salary. And then you don't use all of those income tax credits because, again, the US will normally have a lower income tax rate. And so, you paid 30,000 euros in income taxes, you only use 25,000 equivalent on your US tax return. So you can carry over 5,000. Now you can carry that over for 10 years. And that's amazing because if you're retiring anytime soon, or maybe if you move to a lower income tax country, what you can do is you can use those carryovers against that same bucket of income. So maybe you retire in the next years and then you have pension income, and this pension income is taxed at a lower tax rate. Guess what? You still have all the carryovers from your salary. It all sounds great, but the cons is this form is pretty math heavy and it's pretty intense to use because what you have to do is you have to separate out your income into the right bucket. So you can't use income taxes accrue, you can't use income taxes paid on your salary against your investment income, because salary is generally in the general bucket, whereas investment income is normally in the passive bucket. And there's multiple buckets, so it's like 8 different buckets. There's general, there's passive, there's resource by treaty, there's foreign branch. And then on top of that, not only do you have to figure out what bucket the income sits in so that you can apply the right foreign tax credits, you also have to do this background calculation for alternative minimum tax. So it can be possible that you have like 8 versions of Form 1116 in your tax return when you use the foreign tax credit. So yeah, it's a bit much, a lot more flexible in what it gives you, but therefore that means it takes away your time to compute it, right? I won't repeat everything I just kind of said. This is just like an overall summary of foreign earned income exclusion, foreign tax credit. It is another tax benefit. So in the event you're sitting there and you're saying, well, I have, a foreign state pension, right? A foreign government social security benefits. This is not earned income. I cannot use the foreign earned income exclusion. But because it's a state benefit, I pay no foreign tax credits. So are you telling me I owe US tax? Not necessarily. There is a third one, it's less common, but it's just using the tax treaty. And the US has so many tax treaties that are available. One thing you do have to realize, though, is you cannot take the tax treaty at face value. If you are a US citizen, US green card holder, generally 99% of that US tax treaty is not applicable to you. What they have is called the savings clause, and that's in every treaty. And that basically says out of this entire treaty, as a US citizen, you can use 1 or 2 paragraphs. But luckily for us, those 1 or 2 paragraphs is normally around Social Security benefits. And so that means that if you do have foreign Social Security or even US Social Security and you're retired abroad, you can generally look at the tax treaty to figure out, well, which country has taxing rights so you're not double taxed. And what we will do for you in My Expat Taxes is you just enter in your income and we will automatically look for what's the best tax benefit for you. So we'll model your return no matter which plan you're in. If you're in our base plan, our reviewed plan, or our premium plan, you will get an optimization schedule. So you'll see, well, this is what my return would have looked like under the foreign earned income exclusion. This is what my return would have looked like under the foreign tax credit. And then we'll decide which benefit is best for you. And of course, if there is a tax treaty application that is eligible for you to use, we'll automatically include it with Form 8833, because if you use a tax treaty position, you have to include the Form 8833. Otherwise, there's a $1,000 penalty for claiming a benefit without disclosing the benefit you claimed. That's everything with your US tax return. Obviously, not everything, because there's a lot more information than that, but I hope that was some good information for you to get general understanding of your US tax return. Other things for you to just keep in mind, and I know there's so many things to think about, but of course, FATCA, FBAR, and all of that. So you probably know FATCA already. You tried to open a bank account abroad, you showed your US passport, everyone freaked out, you had to sign a stack of papers. Why? And the reason is because those financial institutions now have to report that information to the US Treasury. And you, as a US taxpayer, you also have to report that information to the IRS or the US Treasury. So there's 2 versions of this form. There's the FBAR. And the FBAR is if your combined maximum balances from all your foreign financial assets. So we break that down. Foreign financial assets is foreign bank accounts, foreign investment accounts. It is foreign pension funds with a cash value. It's not state pension funds because there's not really a cash value there. You don't really have an account. You just have a right to, a state benefit later on. But if you have, an employer pension account, a private pension account, so those definitely count. If you have a foreign life insurance policy with a cash value, right? Technically, that is an investment vehicle that can be used as an annuity later on. That also counts. If you have online banking accounts, so if you have a Wise UK account, if you have a PayPal UK account, we also say include those in there, because technically, if you have a Wise UK account, that's technically a UK bank account. It acts as one, right? It's most likely set up in some type of UK entity. So put those, right, on your FBAR, and what you have to do is you have to calculate, well, what was the maximum balance I had for each account? And this can result in double counting, because if you had, say, $5,000 in one account and then you transfer that to a second account, well, your maximum balance in account number 1 is 5,000 and your maximum balance in account number 2 is 5,000. Add that together and you're hitting the 10,000. So if you go over it, you have to file an FBAR. So unfortunately, double counting does exist and it's okay. I know a lot of people come in and go, but the IRS is going to think I have so much money because I'm double counting how much, the maximum balances were. But there is no tax calculated on your FBAR. It's important that you just report the information because technically the IRS also has it. And the FBAR is not going to the IRS. It's actually going to the US Treasury. So that's also something to keep in mind. But if you meet over the higher threshold of 200K for your combined maximum balances on the last day of the tax year, 300K at any time during the year, if you're filing jointly double these amounts, you also have to include this FATCA form, Form 8938, and this does go in your US tax return. So basically, if you have, a good chunk of money sitting in your foreign financial accounts, expect to file these forms. And that is, again, why it's really important to use an expat specialized software or expat specialized firm to do your taxes, because a lot of the US-based firms or the US-based softwares won't even think about your FBAR requirements. However, you have to do the FBAR, right? If you meet the filing threshold, that has to be e-filed specifically to the US Treasury, FinCEN. And then on top of that, if you meet the threshold for 8938, right, you need to include basically the same information on that form in your US tax return. And that form, again, is a high penalty form. So if you don't include it, there can be, potentially significant penalties that the IRS would charge against you. So that's FATCA FBAR in 5 minutes. I hope at least it gives you an overview of, okay, other things to think about when I'm filing my taxes, whether you've been doing this for, years now, whether it's your first time moving abroad and now you have to think about it for the very first time, just to know that those requirements are also there. One other call out I will put there is if you have children and you're opening up accounts for your children's foreign financial accounts. If your children also have a combined maximum value of over 10,000 US dollars, they may have to file their own FBAR. So just because you may report that on your FBAR as a parent, that doesn't necessarily cover all the bases. If your child also meets the filing threshold, they will have to file their own FBAR. You can obviously file it for them on their behalf, but they technically have to submit their own FBAR. And you can submit FBARs for you, your spouse, and your children all through My Expat Taxes as you do your US tax return. So I close out with a little bit of planning, right? Planning for financial success. And what I want to say there is, e-filing already opened. So e-filing is already opening. The tax season is already going underway. April 15th, like I said, is the first deadline to make payments. If you think you owe, who normally owes taxes? They are people that move in the middle of the year. So if this is your first, so 2024 was your first year abroad, you moved in the middle of the year, you probably have US source income. And what happens a lot is that you would have worked for the US and you're withholding on your W-2. Obviously, they don't realize that you also now have foreign income. So they didn't withhold necessarily enough foreign federal tax. Now, or they didn't withhold enough US federal tax. Another situation is, like I said, if you're a high earner, so this can be, 125K for a married filing separate filer, and then you have investment income, because then you have net investment income tax of 3.8%. If you're self-employed and you are in a country without a totalization treaty, so for example, New Zealand, and then you're self-employed, or Singapore, right? You're self-employed, expect to pay about 15.3% self-employment tax. Again, that will go towards your Social Security benefits, so it's not all loss, but that's something you should plan for, is that you may owe tax. And if you wait too long, you'll end up paying interest and penalties, and that's not going to help you at all, right? And it's just, why do you want to be in a situation where you pay more for no good reason? So another thing to just watch out for is if you are contributing to your US IRA, you can still do so for your 2024 IRA up to April 15th. There are no further extensions. So it's just, you can contribute up to April 15th. Watch out as you contribute for US IRAs. It might be worth it to model your 2024 tax return first to see if you're eligible to contribute, because there are a lot of eligibility requirements, such as having enough taxable compensation, and especially if you're contributing to a Roth IRA, that if you have too much money, you might have to do a backdoor traditional to Roth IRA conversion instead. So a little out of scope for this, but just key words for you to kind of keep in the back of your mind. Obviously, if you don't think that you need to file by April 15th, you can wait till June 15th. So file either your tax return. It's June 16th technically, but I'll say June 15th because, again, if you need to file a 2021 tax return, it is June 15th. It's not June 16th because it's only 3 years since the original due date of that return, which was June 15th, 3 years ago. So just make sure to file your 2024 tax return, or if you have to file back taxes, that you just finish that process by June 15th. And then, of course, you can still file an extension, which you can do for free in My Expat Taxes, but you have to do that by, June 15th, June 16th of this year, is you file an extension to October 15th. And then this will give you additional time to file your US tax return. This is really handy for those that maybe you have a new family member. Maybe you had a child in 2024 and you're going now through the process of how to get them a US passport, how to get them a social security number. This is amazing to do because then you have until October 15th of this year to get their US social security number so that you can claim them on your US tax return and potentially get a refund of $1,700 for them. So as you go through this, right, obviously there is a lot of tax information, and My Expat Taxes is here to help you file your US taxes. But as we realize working with everyone is there's also questions about, investments, and there's questions about tax planning in general. So we do have My Expat Invest, which you can use, and then that will help connect you to, a certified financial advisor that can help you in that journey. That also has a connection with us so that we can understand how your financial movements impact your tax return. And at the same time, if you want to do tax planning, we do have a lot of tax planning possibilities on My Expat Taxes. So as you go through your tax filing journey, if you need any support, My Expat Taxes is, of course, here for you. We have different plans. So whether you want to be in our base plan, which is the most affordable plan, it's a do-it-yourself plan where you get access to, our calculation engine with the optimization schedule, that you're getting the best tax return you can get. And then you also have your FBAR and everything included. Or you say, I want to work with a tax professional and get a little bit more peace of mind. We also have the reviewed plan. Or if you say, no, I really prefer to work with a tax professional from day one, really kind of work through that, make sure I understand my tax return. I have a lot of questions to, think about how to report certain things. We also, of course, have a premium tier for those that, need more help. And if you're streamlining, we'll help you with streamlining. So basically, whatever you need, we're here. We're trying to help you in the most affordable way possible. Like I said, I moved abroad 10 years ago, if you were here at the beginning of the call. And I just remember my first year moving abroad thinking, I can't use a US-based tax software because it doesn't realize the fact that I live in Austria and I earn in euros. However, if I try to go through a traditional tax firm approach, they're asking me $2,000 to start a conversation, and I just have wages. I don't have, I can't afford a $2,000 bill to have a conversation with a Big Four firm. So that's how My Expat Taxes was born. Okay, with that, then we have Q&A coming up. So Hugo, I will let you take back the stage, and hopefully we can get through all of your questions. And if not, there's always ways to reach out to My Expat Taxes. You can find us, Hugo will send everything out, but you can find us on social media. We have a really lively Facebook group where we're always answering questions. You can email us directly at team@myexpattaxes.com. So we are always here for your questions. Whether or not you go with us, we know that the tax filing process is very stressful. So if we can help you along the way, we're happy, right? It's not a fun process, but we're here for you.
Lovely. Thank you very much for that excellent presentation. We've got lots of questions. So I was going to say some of them are very personal. I think if your question is, about your specific circumstances and they're a little bit complicated, maybe just get in touch with the team at My Expat Taxes. MyExpatTaxes.com, as Nathalie was saying, you can communicate by email. There's a Facebook group, various ways to get in touch. So that being said, let's dive into some questions. Is there an income minimum to qualify for the child tax credit?
Yes, there is. You do need to have $2,500 of earned income to start qualifying for the additional child tax credit refund.
And does the My Expat Taxes software calculate the child tax credit?
Of course. So what you would do is you would go in, you would enter, what your income is, and we'll figure out, do you have earned income? Because there's also some special requirements where technically if you have self-employed income, but you're using a totalization treaty, then it doesn't count as earned income. So we'll make sure we understand, do you have earned income? And then depending on the tax benefit you use, for example, if you were using the foreign earned income exclusion in past years, we may have that discussion with you, say it might be worth it to revoke the foreign earned income exclusion and go for the foreign tax credit so that you get the refund this year and maybe even amend your prior tax returns to get the refunds you are missing out on.
Great. Somebody works abroad for a company in California and has been paying federal and California taxes the last 5 years, but doesn't have any property in California. Do they need to continue paying California taxes?
So California, what they will do in terms of 1099, so I assume that now it's seen as self-employment income. Generally, for a state, you don't pay state taxes unless the income is state source. And most of the time, state source income means that you physically worked out of the state. California is a little crazy because they say it's not about you working out of state. It's not just that. It's also if the person that received the services, so if your client is California based, it is considered California sourced income. So in your situation, even if you're living abroad, you may still be subject to California tax because the person you're working for is based in California. So if that 1099, the payer's name and address is California, it's a big hint that California will try to tax that income. Of course, if you can argue that the services rendered are not for someone physically based in California, but maybe that's just where their headquarters is, but you're actually working for someone else, you could always try to file and claim back California. They might just ask a few questions and you can always get, a letterhead from your employer saying, no, this is the actual facts and circumstances. That's a pretty long-winded answer, but most of the time not for states. California is different. It is possible. However, that you might still have to pay California state taxes. However, in terms of federal taxes, you generally shouldn't have to because on the federal side, it's about where you physically are. So you should be able to claim federal taxes back.
Okay, a couple of questions about filing status. Jeffrey says, should you do married filing jointly if you're married but the sole income earner, or should it be head of household? And somebody else says, which is kind of part of the same question, what kind of proof is required to file as head of household versus married filing separately?
Okay. If you're married, so it depends. So if you're married to a US citizen, you can never go under head of household because you're considered married. Head of household is only for those that are considered unmarried. However, the IRS will say that if you are married to a non-US citizen, so a non-resident alien, and they're not electing to file a US tax return, then you will be considered unmarried. So head of household is only for those that are actually single, so not married at all, with, a dependent that they can claim, and they can claim the head of household filing status, or those that are married to a non-resident alien that then qualifies for head of household anyways. I have only seen it once or twice that the IRS has asked for actual proof of head of household. But when they do ask for proof, they basically will say they have a form that you have to fill out. And then it will ask you then for, basically statements saying that you have paid utilities, you have paid for, childcare, you have paid for rent. So normally the proof that is asked, rarely ever asked. Like I said, in the thousands and thousands and thousands of tax returns that we have filed, I have seen it twice, probably. But if they do ask, it will be a certain form that they have, and then you will fill it out, and then you will have to include proof, basically receipts. So obviously the IRS operates on you tell the truth, and you should, always have the records to prove that in the event that they ask.
Thank you. Another question about the child tax credit. Somebody says, I had a baby last autumn. Can I request the child tax credit for 2024?
Of course, I would totally recommend that you file an extension to October 15 ASAP, and you can do that on My Expat Taxes. Just ask us. We normally open it out towards in March, right? But you could already file the extension. And what you want to do is you want to make sure you start that process. So you want to get the US passport, you want to get the US Social Security number, because that can take 3 to 6 months. You can, of course, claim a dependent on your tax return as long as their social security number is valid by the due date of your return. So if you get the extension, then you just need to get that social security number before October 15, 2025. And again, there's other qualifications to get the refundable child tax credit, but normally if you are a salaried employee, you're working in a high income tax country, and you're using the foreign tax credit, you should expect a $1,700 refund.
Somebody else, how would, if the TCJA isn't extended, how would that affect expat taxes, Tax Cuts and Jobs Act?
There's not too much. I mean, basically, a lot of those, I mean, there's a lot in there. I think a lot of that was revolving also around IRAs and stuff. There's really not too much impact because they were not touching our foreign earned income exclusion. They're not touching our foreign tax credit. So this is not, it's really not too much. I mean, maybe you'll see some changes in terms of foreign corporations, but I'm kind of diving now into a separate segue. But for the general population, it's not going to make a big difference.
Somebody else, the refundable additional child tax credit, is it available for children over age 17 who are handicapped?
No, unfortunately not. There's a very strict 17 age limit for this. You can still claim dependents that are older, but then they'll fall in the category basically other dependent, and so you won't get a refundable refund. I'm sorry.
Somebody says, I've been filing the foreign earned income exclusion the whole time I've lived abroad, but I'm thinking about changing to the foreign tax credit in order to be able to open a Roth IRA and receive the reimbursable child tax credit. Are there anything in particular I need to do or keep in mind making that change?
So what I would normally say is when you use the foreign earned, oh, the sun is so strong. They heard me in the beginning of the call. But essentially is when you use the foreign earned income exclusion, that's another reason we say if you don't need to start it, don't, because once you revoke it, you can't use it for 5 years. And so this is a little bit risky. So in your situation, what I would say is, you can go on My Expat Taxes, you can do your return, and we'll normally suggest that you then switch because we'll see that, okay, under the foreign tax credit, you would get a bigger refund. With that being said, what you can then do to minimize the risk is we would normally, especially if you're in our reviewed or premium tier, we would then say it's probably best that you amend your prior year tax returns up to 3 years so that you can try to claim the refund for those past 3 years. But at the same time, this means that your revoking date for foreign earned income exclusion is now 3 years ago. And so now you don't need to wait 5 years from now to use foreign earned income exclusion again. But then you only have to wait, 2 years from now, because technically you've now revoked 3 years in the past, right? So that is one thing to think about there. When you're looking at Roth IRA contributions, do think again, it is important because there is income threshold. So if you are earning a lot, and it doesn't even have to be a lot, if you're married filing separately, if you earn anything, you basically cannot contribute, because if you earn $1 or more, it gets phased out. And then if you earn $10,000, you cannot contribute to a Roth IRA. So make sure you look at that, because the way you would then go around that is you would make a traditional IRA contribution first, and then you would make it then non-deductible and then roll it over to a Roth IRA. So yes, there are a couple things to think about.
That might be one worth talking to somebody about. So have you got a few more minutes if we go over
I
the
do
hour?
have as many minutes as needed.
Perfect. So lots of questions here. So let's keep going for a bit. How is inheritance from an inheritance from a non-US citizen considered?
So there is no
Yeah.
inheritance tax at the federal level. So you're not necessarily paying an inheritance tax, right? Inheritance tax there is, but it's an estate gift tax. So that means that the person that it's giving you, the inheritance would then be subject to gift tax, but obviously they're not a US citizen, so this is not too important. What you do have to consider is if you get over 100K in gifts from non-US citizens, this can trigger a Form 3520 reporting. So the Form 3520 is for pensions, or not pensions, but normally it's foreign pensions. So it's for foreign trusts and foreign gifts. So if you have over 100K, again, from a non-US citizen, you may have to disclose this on Form 3520. And this is really important you do this because if this form is late, you will automatically get a $10,000 penalty from the IRS. They do not play with Form 3520. This is the one form where I see those notices coming out like automatically. You can fight them, but it's a very long fight. So if this is you, get on it. Make sure you get your extensions. Make sure you file 3520. We do that for you in My Expat Taxes. There is an additional cost for the form because it's a high penalty form, but we will help you file 3520 if needed.
And that's so there's no tax on it's just a reporting form.
Tax, just
But it's not
reporting.
taxed as income, a gift like that. No,
No, there's not
right.
tax. There's no tax. It's you just have to disclose it. But if you
Right.
don't disclose it, then there is a $10,000 penalty. So it is very important you disclose it.
Okay. Somebody asked, does property count as foreign financial assets for reporting on FBAR or FATCA Form 8938?
A property itself, like a residence, a property, it's not a foreign financial asset. Obviously, any bank account that's related to a mortgage is, but real estate is not a foreign financial asset.
Somebody else, does your software support automated PFIT calculation?
So I think there's nothing automated about PFIFs. I'll tell you that one, but we do support PFIF reporting. So when you go in, we'll ask you about your PFIFs and we'll ask you for the transaction history. And what we will offer is we basically have probably the lowest PFIF report preparation fee. So we charge 49 euros per PFIF. And I think the standard is more closer to like 99 plus per PFIF, if not even higher. There is no automation there because PFIFs are terrible. But they're really not. They're fine. As long as you know your transaction history. So you'll have to follow through and enter the transaction history, and then you'll be prompted to work with a tax professional. And then we'll have to look at your prior PFIF, declarations to make sure that everything's aligned. So no, it's not automated. Yes, we do we do support it, and we do support it for generally the most affordable rates possible. And we do so many PFIFs. And it's also for anyone that did make PFIF investments, so investments in foreign pooled funds in 2024, please file a timely tax return because you may be able to make a first-time election mark-to-market election, and this is something that requires a little bit of planning, but is generally a good way to go when it comes to PFIFs. And we do that for you, of course.
Okay, thanks. Somebody else, does a credit union account have to be reported on an FBAR?
I would assume that's a US account normally. I mean, it depends if
Some foreign equivalent, or I'm not sure. Yeah.
So what I always say is look at the financial institution. If the address of the financial institution is not in the US, report it. If it's in the US, it's a US account.
Somebody else. Okay, for a 19-year-old accidental American with no income, who will want to renounce, but I think to renounce they need 5 years of tax filing, but they've got no income. Do they start filing anyway to build up those 5 years?
Yeah. So what you'll generally do is it's catch-22 a little bit, but yeah. So definitely file now because at least you get the $1,400 refund for 2021, and this will offset your filing expenses later, right? So I would say file now, go under streamlining. We'll help you go through that. We'll get you the $1,400 refund for 2021. And then you'll have to file 3 years. You could technically try to streamline and file 4 years. So you could technically file back to 2020 to just have it on record. Because as Hugo said, you need 5 years on record. And even though you don't get the refund for 2020, we do have some people that will try to file 4 years under streamline so that they can renounce the very following year. So then you would file your current year, 3 to 4 years of back taxes, and then next year you could renounce, or you could renounce the year after.
Somebody else, does the software help you figure out what bucket your income falls under for foreign tax credit?
Of course. So you just enter what you earn, and then you enter your foreign taxes, and you can separate them by how much tax you paid per each income stream if you know it, or you just have a part at the bottom of the screen when you get there that says this is how much I paid in total to Germany, to France, to wherever. And then we'll go ahead and prorate it per bucket. So we'll prorate it between, general, passive, resource by treaty, foreign branch, et cetera, et cetera.
Thomas asks, so US citizen living in Italy and wants some help with their expat taxes. If I use my expat taxes, can I be confident in avoiding double taxation?
Yes, definitely. I would say for those that are US citizens in Italy, the one trickiest part for people that are self-employed. If you're self-employed in Italy and you're a US citizen and you're not an Italian citizen, you will still be subject to US self-employment tax. So just be aware of that. It's not double taxation, but it can trip people up because they don't realize that and they pay into the Italian system, but then technically you're supposed to pay in the US system. So yes, you can use us. We even have some preparers that are in Italy, so I need to visit there, but we have a lot of US citizens in Italy that use My Expat Taxes. We have a lot of US citizens all over the world in every different country using My Expat Taxes. And, I think our goal is always to make sure that you are never double taxed and that your return is optimized.
Here's an interesting question. What advice would you give to someone who is planning to move abroad this year to make things easier in advance?
To make things easier in advance. So one is probably I mean, it depends. Like if you're a wage worker, it's never going to be too complex. But what you should do is obviously if you have a W-2 and you have some type of federal tax withholding, I would generally say to see if you can make sure you get as much withholding as possible. Because like I said, the situation is people will have a W-2 and they might try to get a lower federal withholding. And then they move abroad and they have foreign income. And then their income is higher. So the federal withholding doesn't quite match. So that is one, you basically want to cut state ties. So if you're deciding to move abroad permanently, you might want to make sure that you cut state ties. So cutting state ties could be anywhere from, just making sure that you don't keep having property there, you don't keep living there, maybe you end your driver's license there. You don't have to do these things, but it makes it a little bit more clear that state residency has been cut. It's nice if you have a US bank account still when you move abroad so that you can still work with the IRS pretty easily. And then when you move abroad, make sure to keep monthly pay slips because especially if you move to the UK or a country that has a different tax year, so not January to December, but randomly April 4th to April 5th or whatever it is, then you'll want to rely on monthly pay slips so that you know how much income you earned and what taxes you paid locally. So the main thing there is just really keep documentation, right? But there's not really deductions you can claim, like the moving expenses is not claimable. So this is something that happened in a while back, but so there's no real expenses to claim there. I think I answered that question, but basically
Yeah.
it's keep documentation. And if you have some suspicion that your federal withholding is not high enough, then, try to then pay an extension payment or just make sure you file by April 15th of the next year.
I've heard, I think as you were saying about cutting state ties, I think that particularly applies in certain states like California. Some people move state before they move abroad. So
Yeah, some people will move states
yeah.
before they move abroad. You don't have to get so extreme. I mean, it's what I would normally do is if you move abroad in the year you move abroad, make sure you file a part year to say that, hey, I moved from the state, and then the following year file a non-resident, and then that way you have it on record that you put the documents there on record because there's nothing you can actually send to California to say I left, but you can create a paper trail by saying, okay, I filed part year, I have a date where I moved out, and then the following year and maybe 1 or 2 years after, I keep filing a non-resident, even if I have no CA source income, just to prove like I left. This is my paper trail.
Okay, let's just do a couple more. Dave says, how do you indicate when reporting self-employment income that you live in a country with a totalization agreement?
What was the first part of the question?
So reporting a self-employment income from abroad, but if there's a totalization agreement, which I think means you won't, yeah.
Yeah, so there's quite a lot of totalization treaties. What you do, it's a little tricky because technically the IRS wants a certificate of coverage for anyone that's self-employed. If you don't want to pay self-employment tax, and sorry, I'm like facing because the sun is just blinding me, but it's if you are self-employed and there's a totalization treaty, what you can do is you can claim it, and then you would technically include a certification of coverage in your return. However, you cannot easily get this from most local governments because I mean, you can go to the UK and they might be like, I don't know why I would give you this form. Some people get it, but long story short, that's the safest way. And then you paper mail your tax return, you include your certificate of coverage, and you say, I am exempt from self-employment tax. But this is not really the reality, and especially the whole fact that you have to paper mail the tax returns. So what is the general practice people will do and what we do as well is that you'll enter your self-employment income. We will include a treaty-based position that you're claiming the totalization treaty inside your tax return. And then we will then include a couple other statements to say that you are exempt because of totalization treaty. And this can then be e-filed. So this is pretty much always accepted by the IRS as another way to do that. It can happen that they may follow up and say, can you provide us a certificate of coverage? And if you don't have one, you could normally provide a local tax return to say like, hey, I did pay my Social Security taxes, my self-employment tax locally, so don't come looking at me for that money. I hope I answered that. But yeah, we do support that. And we do it in a way where you can e-file. There is definitely a way where you would paper mail the return, but this is just it's not very fun to paper mail a return.
Somebody else, can my expat taxes cover amended returns for past years?
Of course. We've covered streamlining, we can cover amended returns. At this point, I always think back a little bit fondly. So we started back in 2018. And when we first started, we always said, okay, we just, we're starting out, we do a do-it-yourself tax software for salaried folks, right? Just to make it a little bit easier for a little bit of the population. And because there was just so much demand, I mean, now you can do anything with my Expat taxes for the most part. If you have foreign corporations, 5471s, your foreign pensions, 3520s, you're streamlining. If you're streamlining from abroad, if you're streamlining domestically, if you have PFIPs, you can pretty much do everything. We are always here to try to help you. And, if you have dual status returns, et cetera, if you're expatriating, if you're starting. So I would always say, just send us an email. And if for some situation we can't handle a return, we will let you know. But generally, we will always look to help you if we can.